Okay, so you probably think of moving averages as just a simple way to spot the trend, right? Well, what if they could do so much more? Today, we're going to pull back the curtain on a really cool way to use this classic tool, turning it into a living, breathing guide for your charts. You know those straight horizontal lines we all draw for support and resistance? I mean, we've all been there, but what if those levels weren't just stuck in one place? What if they could actually move with the price, flowing along with the market's momentum? That's the core idea here, and trust me, it's a total game changer. Let's dive in and see how this actually works. All right, so that leads us right into our first big idea. What are dynamic levels? It's time to ditch the rulers, you know? Let's let the market do the drawing for us. So, what is a dynamic level anyway? Well, to put it simply, it's a support or resistance level that isn't just stuck. It's not a fixed line. It's kind of alive. It's constantly recalculating and moving with every single new candle, adapting in real time to the pulse of the market. And this slide just lays it all out perfectly, right? Over on the left, you've got your traditional static levels. You draw them once, and that's it. They're set in stone. But on the right, dynamic levels. See how they flow and curve right along with the trend? It's a totally different way of looking at your chart. Okay, so this all sounds great in theory, but how do we actually see these dynamic levels on our charts? Well, the tool for the job is probably one you already know and love, the good old moving average. Let's get practical and see how to use it. All right, check this out. We've got a 15-minute chart here. See that curving blue line? That's the 50 EMA, the 50-period exponential moving average. Now, just watch what happens every time the price rallies up and touches it. Bam, it gets rejected, right? It's like it's hitting an invisible wall. That EMA is acting like a dynamic ceiling, a moving barrier that the price just keeps respecting. And that's the key takeaway right there. Instead of a boring flat line, that moving average gave us a ceiling that was constantly adapting. For a trader, that means multiple chances to think about a short position, all guided by that one simple flowing line. Now, wouldn't it be great if the price just perfectly bounced off the line every single time? Yeah, in a perfect world, maybe. But we all know the markets are messy. They're not that clean. And that's where we need to get a little more flexible and start thinking about trading in the zone. You've got to remember, these moving averages aren't, impenetrable brick walls. A lot of the time, the price will poke its head through the line by a few pips before it decides to turn around. If you're waiting for a perfect, pixel-perfect touch every time, you're just going to get frustrated. It's not going to happen. So to deal with all that market noise, a lot of traders take this concept one step further. Instead of relying on just a single line, they'll actually put two moving averages on their chart. And what that does is create a zone, an area of potential support or resistance. And this chart shows that idea perfectly. We're looking at the same chart as before, but now we've added a 10 and a 20 EMA. See that shaded area between them? Think of that as a danger zone for anyone trying to buy. Every single time the price pushed into that zone, sellers jumped in and took control. It's just a much more forgiving, more robust way to look at resistance. So here's the big mental shift you have to make. Stop thinking about an exact line. Stop getting fixated on one specific price. Start thinking in terms of zones or areas of interest. Trust me, moving your thinking from a line to a zone can make a world of difference. But look, no level, static or dynamic, is going to hold forever. They all break eventually. And what happens after the break? Well, that's where one of the coolest patterns in trading comes into play, the role reversal. Okay, let's go back to our first chart with the 50 EMA. For a long time, that line was like a brick wall, right? Unbreakable resistance. But then, look inside that highlighted box. The buyers finally found the momentum to punch right through it. The ceiling just got completely shattered. So, okay, the trend has obviously shifted. But the story of our 50 EMA isn't over yet, not by a long shot. In fact, this is where things get really cool. That old ceiling is about to become the new floor. Let's just walk through this step by step. Step 1, the 50 EMA was acting as resistance. Price kept hitting it and falling. Step 2, price finally breaks through that resistance. And step 3, this is the magic part, on the next pullback, the price comes back down, tests that same moving average from above, and then bounces. The old resistance has totally flipped and become new dynamic support. This is that classic role reversal, and it can be an amazing setup to watch for. All right, so let's wrap this up with the key takeaways. First, dynamic levels move and adapt with the price. Second, moving averages are an awesome tool to track them. Third, and this is a big one, think in zones, not exact lines. And finally, always keep an eye out for that classic role reversal when a level finally breaks. It's a powerful concept. Honestly, looking at charts this way can open up a whole new world of analysis. It really adds another dimension to your trading. So the only question left for you is, which moving average, or maybe which combination of averages, are you going to start playing with? Get on your charts, start experimenting, and see what you can find.